You're listening to the Practical Wealth Show with Curtis May.
Hey, you guys, welcome to another episode of the Practical Wealth Show. And in this episode, I have a special guest, Bruce Mack. And Bruce and I discuss how to empower and protect, basically show you how to grow and protect your wealth and kind of build a wall around your financial fortress with bulletproof asset trust and how to mitigate taxes. But let me give you a little background before we go into it. Bruce is the owner and founder of Platinum Financing Group. He knows that his funding options and asset protection programs are perfect solutions for small business owners. So with this is kind of, we talk about our process. We're going to talk about business, how to grow revenue, and generate and protect your assets. So this is kind of a growth meeting, all right? He's got the perfect solution for all business owners to achieve complete financial freedom. And we all about that here on the Practical Wealth Show. And as a licensed financial advisor and a former licensed and bonded credit repair company, former owner, Bruce empowers small business growth through customized funding options, including all lines of corporate credit building programs, and more. And he's especially passionate about educating clients on asset protection and the tax mitigation benefits of his unique, specialized business trust. Bruce is here today to share his expertise to help you find or to help you protect your assets, mitigate your taxes. This show, what we're going to do is we're going to do a follow up on the money part. But what I want to do is talk about protection and trust today. So, Bruce, welcome to the Practical Wealth Show.
Well, thank you so much, Curtis. It's a pleasure to be here.
So, Bruce, did I miss anything? Tell him what I didn't tell him.
Well, see, I'm long in the tooth. I'm 68, so there's a lot of story there. A couple of points of potential interest with the folks that are. I've been a very avid real estate investor as well. Mm-hmm. I bought, rehabbed, and flipped over 160 properties in a 3-year period of time, and have been involved with $92 million worth of real estate transactions. So I've been on all sides of the equation, and I've had a profound interest in trusts for decades, going back over 30 years, which starts with the basement level trust, that being the one that most people are familiar with. They say, well, I got to get my assets into a trust so when I die, they're taken care of. And that type of a trust, so they're all very clear that what I call ground floor or basement trust is what's called a living trust. And that living trust, those generally are in the $750 to $1,500 price point, and they're even available on LegalZoom and other places. And they are great for the purpose that they serve, but the purpose that they serve is very simplistic. And that is, that they are perfect for avoiding probate. And you never want to go to probate, because probate means you're going to have trustees that are court appointed, and those trustees get a percentage of the estate.
Okay.
And why would you want to have that happen? And then secondarily, because they specifically spell out who the beneficiaries are. So before you get to the grave, you're trying to ensure and being able to ensure that there's no squabbling, infighting, unhappiness, because it's clearly spelled out who the beneficiaries are. So from that standpoint, they serve a great purpose for those two items. That is not what we do, though we do incorporate the beneficiaries into our trust, and we do incorporate the fact that there will be probate avoidance in our trust. But our trust is much more encompassing, and I would call it a big boy or big gal trust.
Okay.
The key and cornerstone points being, one, bulletproof asset protection. And when I talk about bulletproof asset protection, I'm talking about asset protection that means that not even any third-party creditors, governmental agencies, nobody can crack into this titanium vault asset protection, either lien or get a judgment against the trust or you. So that's number one. Number two, we're also talking about tax mitigation and the tax advantages. And the tax advantages are significant depending upon the type of income that the individual has, that we have the ability to defer pursuant to the IRS tax codes that have been woven into the fabric of the trust.
So hold it. All right. So you got me excited now. So tell me who should be, because people will throw around, oh, I want to get a trust. I'll have clients say it, but they just know the buzzwords. They don't know what it is. But I think asset protection, because as you become more successful, it's just a bigger bullseye on your back, and you have to learn to what I call play good defense, right? So these titanium asset protection trusts, you're targeting business owners. Who would you say is the ideal person that ears should perk up as we go through this conversation?
Anybody who has assets, an asset base, is someone who is a prime candidate for getting one of our trusts. Now, I'll give you a perfect example of a non-business owner that would fit that mold. Somebody who had inherited property or money or both, or stocks and bonds from a family member. Now they've got hundreds of thousands of dollars or more. And now they became that, like you said, that person who's got a big target on their back, and they could be easily litigated against, and that money could be lost when a charging order is executed against them. So they don't necessarily need to be a business owner, but having assets is pretty much a prerequisite, because if you have nothing, then there's nothing to protect. But I will also tell you, we do a lot of work with younger people who are just up and comers, because one of the things you may not know, or some of the folks that are on the show today may not know, is if you lose in a lawsuit, not only can they attach your current wages and take your current assets, but unfortunately, I've seen on a number of occasions where future income can be attached.
Wow.
So as a mid-25-year-old, let's just say, who has a big, bright future, they may go after your future income and attach that. That would not be a good day. That would not be a good day. And one of the first things that we take out of the equation and we put into a trust is your vehicle. Vehicles, unfortunately, are huge liabilities. And then there's the fact that as a parent, we now have kids, and kids
yes.
driving age.
Yes.
And those kids, maybe they're going out and they're drinking, or they're having some fun, or maybe they're speeding, and maybe they're getting into an accident. Maybe people are getting severely injured. I mean, I myself lost a nephew. There were 3 out of 4 people that were in that car that evening that all passed away in a very tragic car accident. So I think we all who are on this phone know somebody who was either diminished in terms of their capacities for their life or lost their life in a car accident. Mm-hmm. Well, with a trust, the assets are all sold to the trust. It's a paperwork transaction. It's very simple to complete. And then the good news is, as the trustee and or compliance overseer of the trust, you and or beneficiary, depending, you get to enjoy those assets. How nice that is. And you get to not have to worry that if the asset got into an accident that they could come after you, because the asset got into an accident, you didn't get into an accident. So this becomes a very, very strategically so much better way to go. All assets are sold. They go into the trust. They can sue a trust. but it will get thrown out immediately because the type of trust that we have, which has special provisions in it, which, by the way, our trusts are copywritten, and we have 58 copyrights on them, and they're proprietary in nature.
Wow.
So that we just cannot have one of our trusts broken into unless fraudulent conveyance was construed and was proven. And what's fraudulent conveyance? Well, if you're in a suit, that doesn't mean if you were in a traffic accident. That means that, and don't wait until you're in a traffic accident to try and get a trust.
Right. You can't buy insurance when your house is on fire already.
Right? Yeah, exactly. Right. Let's go and pay that policy today. I think I see some smoke and flames out here. No. But if you're in an accident, and I like to tell this story actually. We have a client. They have a riding stable. They had a client that was thrown off of a horse. Yes, they were getting some telegraphing that there was going to be a potential lawsuit. They did get a trust. Ink was dry, and yes, a summons came down, and yes, they were protected, because the threat of a lawsuit is one thing, but until there actually is a lawsuit, this would not be a fraudulent conveyance scenario. But we always encourage people to get a trust when there isn't even the whiff of an impending problem, because you never know what can happen.
So assets. So let's say I've got a family, I've got cars, I've got a house, I've got business, and let's say I have, 2 or 3 or 4 investment properties.
Yes.
That's
everything you just said.
Mm-hmm.
And I'm gonna throw a few other things in there.
Okay.
What about some jewelry? What about potentially some metals, some silver or gold? What about your stock and bond trading accounts? Everything of a tangible and or intangible value is sold to the trust. For instance, somebody might have come up with a proprietary operating system on how they approach their lead generation for their business. That could be sold. Their websites could be sold. Everything that has, like I said, a value to them all gets sold to the business. And oh, by the way, that sale is a paperwork transaction. It only takes a couple of minutes, and it's extremely easy to do. Once those assets, all your worldly possessions, tangible and intangible, are in there, then the good news is they cannot ever have a lien or a judgment by any third party creditor, including and or governmental agencies, unless that fraudulent conveyance could be proven. That doesn't mean they can't come after you. Doesn't mean that they can't win a judgment or lien against you. But if they did, there's nothing to collect.
Right, because you don't own anything. You control it. What did it say? Control everything, own nothing. That's
the exact statement that Nelson Rockefeller said some time ago. And I completely concur that the wealthy in America are in exactly that position. They own nothing. They control everything. And this gives everybody a chance to be on a level playing field and be in that exact same position from an asset protection standpoint.
Wow. So how would they use it? So, you would move like accounts in there, checking account, your house is in a trust, whatever. You can still transact business.
Oh, absolutely. Matter of fact, let's talk about accounts. That's a great stopping place for a moment, if you don't mind, Curtis.
No, please.
I get this question all the time. Well, I've got 2 or 3 rental properties, or, well, I've got a business. I have a business checking account. Yes, that's great. And you can continue with that checking account, and you can continue to have your tenants pay to the other checking account, which you may have set up strictly for your real estate investment business. However, that is problematic, because if you don't continue to sweep those accounts on a regular basis and move those funds into your new trust bank account, which, by the way, takes about 15 minutes to set up. You go into a bank, and we have certain banks that we work with that do not require, and they're national banks that do not require an individual to fork over the trust. And the trust is a private document. You don't want it on file with the bank. All you should be able to do with the bank is to file what's called an affidavit of trust, which they notarize a little form. Boom, it's done. You've got your bank account. So I generally coach clients, though it's up to them. They can go utilize their old way and then maybe once every week or whatever, sweep that money. But do understand, if they go that route and there was a lawsuit that came down, the amount of money that would be in those accounts at that time is subject to being liened and or being seized and or being having a judgment.
Because at that moment, that's a fraudulent conveyance. You got a whiff of something that may be coming down the pike, and then move it over. You can't do that.
Yeah. So
I want to make sure we get that point. So let's say I got a business, I got these accounts set up, but now I'm going to set a trust. I'm going to sell my assets to the trust. Yes. I need new accounts, but the accounts. So let's use my bank, my company, Practical Wealth. I have a business account. This is Practical Wealth, Advisors LLC. So my new account, if I put it in trust, would say what?
Oh, your new account could say whatever you wanted it to say. I urge people not to use their first and last name, but it could be the irrevocable business trust or the Curtis.
But trust would be on the account. It would some kind of way on the check. It would be, but I could still do whatever I was doing, debit card, check writing, whatever.
Absolutely. And the only difference is when you sign the check, you're signing the check, Curtis May, TTEE. So you're adding just 4 letters to your signature, i.e. those signify that you are the trustee of the trust.
Wow. And so so let's say you take a family.
Sure.
Who's the who when you're creating the trust?
Well, that's a discussion that we usually get more in depth with, and I'll touch on it when we do a consultation.
I got it.
There could be many who's and many different structures. For instance, let's just say that an individual is concerned that there may be a divorce in the future. One of the things is divorce a lawsuit? Yes or yes?
Yes.
Okay. So if they were to set up the trust and that was a concern, then we would certainly want them to be both the compliance overseer and the trustee, and the spouse would be the beneficiary. The beneficiary would be very happy with that. But the practical reality is that the trustee has the sole and discretionary ability to add and remove beneficiaries with the stroke of a pen.
Okay.
And I don't care if it's a common law state or whether it's a community property state. So you get where I'm going. This can be the best prenup or postnup that has ever been out there. So now we're talking about reasons where people would, again, back to why would somebody want asset protection even if they don't have that many assets? Well, here's a really good reason why they would want a trust. If there was potentially some issues on the home front, or they foresaw that there might be, or maybe they aren't even married yet. Mm-hmm. This is, again, why bring up that horrible prenup, postnup scenario when it doesn't need to be. But oftentimes one of the spouses, if there is a marriage, is the compliance overseer. The compliance overseer actually has hiring and firing ability over the trustee. There's a trustee, which could be the same as the compliance overseer, and usually they usually form a dual function. And then there's the beneficiary or beneficiaries, which could be the spouse, could be the children, could be nephews, the nieces. It could be anybody. It really, it's up to whoever the individual's imagination is that they want to. Could be a charity. Could be again anybody.
It's a lot. Oh wow, you've changed a bunch of people's lives with this call right here. That's why I knew this would be a fascinating topic, because I'm thinking here going, my mind is racing of clients I know where I've talked about it, but I just, there's different ways to, different layers of this stuff that you want to be able to do, but the trust thing has always eluded me. So this is powerful stuff, because it's like you need to, especially if you're like when we work with clients, most of our clients are like, families that are growing, business owners that are growing, real estate, or people learning to do real estate. So, I like people like that, because their future will always be bigger than their past, because they're always trying to make more money, get better, that kind of stuff. But you've got to grow, but you have to play defense. So really what I'm hearing is you need to play defense from the get-go. You need, like the first level is probably like protection and, liability coverage and, errors and omission. But really, as simple, you just made this thing sound, it's like, boom, let me get all this stuff out of my name and drop it in here, and then just go to work. And now it's I tell people, look, you want to be like I hate to say, don't get mad at me if y'all listen to this. You want to be like the Catholic Church. And in terms of they always have stuff coming against them, but they don't lose any assets because they've done really good asset protection.
They've done a fabulous job.
Right. So I tell people, don't hate the player, hate the game. And you got to know the question you need to ask is, how can I do that? Don't get mad. You need to ask yourself, how are they doing that? And how can I incorporate that into building my fortress of solitude?
Let's talk about a couple players that we all know, which would be the Kennedy family. Mm-hmm. And the Kennedy family, there was an article in Forbes magazine back in 2014 that says the Kennedy family defies death and taxes. And an excerpt of that article in Forbes said something to the effect, and please don't quote me, but I'm really close. It said something like the Kennedys have with their specialized trust, have the ability to potentially defer taxes forever. Now, this notion of tax deferral is really the other 50% or the other compelling reason for so many people to want a trust. Our trust, pursuant to 643 of the IRS tax code, has a tax deferral component for business owners. It was designed with that in mind. And when we dig into the code, the reality is if somebody has W-2 income, we cannot defer that out. If somebody has property taxes, we cannot defer that out. But we're talking about being able to strategically defer. You were talking about that just a moment ago. And a great deferral component that a lot of people use is they use a 401k or an IRA. They're tax deferral strategies, sound ones, and you defer out until you have to start taking your RMDs. And for those of you who don't know what an RMD is, it's a required minimum payment distribution, exactly. And that starts at 70 and a half. The way ours are set up, and the way the trust is written, the languaging in the trust states that the trust does not distribute until 21 years after the last of the beneficiaries has deceased and 21 years after the last of the beneficiaries' heirs has deceased.
Wow.
If we apply a little sense and logic to that, that could be 100, 200, 300 years from now. I don't know when that is. I don't have that crystal ball for all of us. It's not even for myself and my family.
Right.
But whenever it is, because of the way that the trust was languaged, there is no one, because we've kicked this tax can down the road, there is no one that is connected to or has any kind of connection whatsoever to the trust when that tax bill comes due, because that's when the trust distributes. What kind of monies are we talking about? Well, we talked earlier about real estate investors.
Mm-hmm.
They get two types of income. They either get lease and or rental income, type A, or they get long and or short-term capital gains, which is B, right?
Mm-hmm. Yes.
And we work with a lot of real estate investors because on that capital gains issue, there's other issues. For instance, they can do one flip. That is, real estate investors can do one flip, and they could get cast as what's called dealer status. Yep. So instead of being at the 20 or 30% capital gains, whether it's short or long term, which is a year and a day, you become a dealer. You also have to pay the unemployment taxes, and everything that you're doing is being taxed as ordinary income.
Wow.
That ain't pretty.
Right.
So when you're selling your assets, of course, you don't own them. That doesn't mean you can't control them and enjoy them and get to play with them. That just means you don't have the burden of owning them, which is exactly, again, where you want to be. So dealer status is off the table. So when businesses that we work with, whether they do or they are not real estate investors, they sell their business to the trust, and then they lease back generally 70, 80 or so percent of the assets. And when we set these up, the bottom line works out somewhere between, with our typical client, that whatever they were paying between their state and federal, if they even have a state, because of course we know that there are several states that don't have state income tax, like Washington and Texas and Nevada and so on and so forth. But generally, the reduction in the person's out-of-pocket check that they would write to whether it's the state or to the IRS, we're seeing about an 80 to 90% reduction annually. Now that is absolutely huge, because if you can redeploy that money and you use it strategically and being able to arbitrage it by getting the compounding capability of what that money can mean over, let's say, a decade or 2 decades or 3 decades. Now, whatever that money is becomes a very, very significant amount of money. So that's the secondary or the other reason that people absolutely love our trust is the tax.
I don't even know that's secondary. That's hold it. All right, let me stop. Let me. I want to get my mind around this. So let's say my business is generating $500,000 a year.
Sure. In gross
revenue. So, but the trust owns it. So I may pay myself a salary. I've got business expenses, the same stuff so all that stuff is still the same. So how is it that you're saving on federal taxes? That's what I'm missing.
Because pursuant to 643 of the IRS tax code, when monies go into the corpus of the trust, they have the ability to be deferred, and they are deferred unless they are taken out. And you're not going to take them out because, again, I told you get to use them, play with them, and enjoy them, and then put them away. The only thing that becomes taxable income, and I think maybe this is an easier way to answer that question. The only thing that becomes taxable income post getting a trust, so everything else becomes a trust expense. You can buy property. You can. The trust can buy property, I should say. The trust can buy cars. The trust can buy jewelry. If it's germane to that business. Now that, again, that's if they're in the jewelry business. I shouldn't say buy presents of jewelry. No. There's 3 categories, taxable distributions. Taxable distribution number 1 would be food, 2, fun, 3, fashion. Now, as long as they are not in those categories, invariably, it's going to be a trust expense, including much more liberal expenses on your home, such as your gardener becomes a trust expense, such as your cable bill becomes a trust expense, such as your pool maintenance guy, such as repair and replacement of furniture that needs to be there for the beneficial enjoyment of the beneficiaries that live in that residence, such as education, such as wellness, such as maintenance and support as seen fit and necessary, and at the total discretion of the trustee, which would be you, making the rules up here. More good news. We talked about those taxable distributions to take care of food, fun, and fashion. Well, an individual has $12,000 every year. Married couples have an exemption of a tax exemption of $24,000 every year. And for every child that you have, that's an additional $2,000. There's also an additional exemption while they're at college, I believe, of $2,000. So let's just say we have a family of 4. We now have $12,000, $24,000, $26,000, $28,000 worth of exemptions. That buys a lot of food, fun, and fashion. But let's just say you go over that. Well, for the first $19,000 over that, should you exceed that limit, the tax rate is at the lowest basis, which is 10%.
Wow.
And in the next bucket, which is, I believe, roughly, don't quote me, $70,000. If you go into the next bucket, not retro, but that portion that's in the next bucket, the next 70,000, it's at 12 or 12.5%.
Wow.
So again, most people don't even get into bucket number 1, but if they need to, so what? It's 10%.
That's, yeah. I mean, compared to what they're doing, that's nothing. I mean, that's wow. All right. Let me get my thoughts here because my mind is racing. I'm trying to think of some coherent questions. So how do you, so if somebody were to read, I think this is kind of the next step because I think that, we've got a good general idea, but it really, folks, these are ideas that you can do, but you need a professional, you need somebody that understands this. And this is a process. So for example, there is the trust part, and then is it done in conjunction, for example, with a bookkeeper, a tax professional that understands this stuff, or is part of what you all do perform that function, or you integrate that with, their current professionals or that type of thing?
That's a great question. I realize that the only way to offer a service like this is to have it being an all-encompassing program. We have 58 copyrights on our proprietary trust, so nobody else can even get it. We have tax professionals on staff that know exactly what to do, how to do it, and work with our clients on a daily basis. We have over 31,000 of these instruments out there. We've filed countless thousands of returns since 1999 when we first came out with the trust. Not one of them has been audited. So what we do is when a client wants to move forward, they get assigned to one of our tax professionals because there's going to be an occasional question. We know that. And we have a in-house rule, and quite literally it's in the proposal. So there's the written word as well that says that the client is entitled to 1 full year of complete unlimited access to one of our tax professionals. So that's piece number 1. Piece number 2 is invariably what we have done to make it easier for the client, and because it's usual that the person that they are using, whether it's themselves, which a lot of people do, or sometimes they have another tax professional that they've used before to file their taxes, we will work in concert with that other individual. We opt to do it for them. So we do both the trust return and the 1040 return. So our clients get a package. They get their 1040, they get the 1041, they get the unlimited consulting from one of our tax professionals. Then that way they have everything that they need. It's a one-stop package so that they know exactly what to do. And they've got the consistency and are walked through exactly what to do with the entire process.
That is outstanding. I mean, really, you just want to, especially with something as complex as this, you need a specialist that knows how to do this. Otherwise, it's like, oh, my attorney can figure it out. They really can't. So, yeah, so that is really cool. So, tease on this because we're going to do another talk on this before we kind of wind down the interview. So, you also do, and I think this is more visual, so we actually may do a short webinar on this, but you on the other side. So we just had a really awesome and fascinating discussion about asset protection and tax mitigation. Bruce also helps people with funding of their business and funding strategies. So tell them a little about that as we, kind of give them a trailer to our next talk.
We have multiple funding platforms. One is our 0% APR program for up to 21 months. And we have a strategy where we can show people how to receive 0% APR for almost 3 years through a second round of funding. That program, the average client gets $75,000 worth of revolving lines of credit, as much as $150,000 on the first round of fund. And then they come back and they can pick up an additional up to $100,000. So a $250,000 aggregate over a period of time. Secondly, we have a fintech platform that has 25 lenders on the platform that we've put together. So with answering about 12 short questions online, pressing a button, and not getting a hard pull, it's a soft inquiry. We can get you potentially multiple offers for anywhere from $1,000 up to $50,000 if that's how much you're looking for. And that can be funded within in as little as several days to a week. The money can be in the client account. And then third, one that we work very closely with is what we call our BDRA, which is our Business Directed Retirement Account. For those of you who have an IRA or 401k that is rollable or rolled and is currently at an administrator in a self-directed environment, you'll really want to hear about this because unlike the prohibited transactions that you're currently being chatteled with, and you can't do things like regular business activities. You can only buy real estate. You can only buy stocks and bonds. Wouldn't it be nice if you could use some of that money for doing build-outs or doing marketing or perhaps buying courses from professionals in the vertical that you're involved with? Well, I'm here to tell you that as long as it's a business-related activity and you've rolled that money into our BDRA, therefore it stays in this qualified plan, you can use it for any business usage whatsoever. So this is another funding source that people can access that if they've got that IRA or the 401k, we can help them. We can help them do that rollover. It's very, very simple.
Right. So how do we going to help you jailbreak your IRA so you can do more?
That's a great way to put it. Jailbreak your IRA.
Jailbreak your 401k, right? And I stole it from somebody, so feel free. So that is fascinating. What would be the best way if our clients are interested in what you just said, even before we do the other meeting, and also on the trust? What is the best way for them to, and we'll put it in the show notes, for them to reach out to your company or to you?
Certainly. I'm waiving our normal consultation fee for your listeners. If you're interested in the trust and have more questions on the trust, let's book out for an hour. Go to platinumtrust.com. platinumtrustgroup.com. That's platinumtrustgroup.com. And on there, there's a scheduler. Pick a time. It'll get you into right into my calendar system, and then we'll meet together. Make sure that when we do this, that you're by a computer. And the reason is we're going to go through a slideshow because you'll get some visuals and you'll see exactly what a lot of these things are that we've been talking about, and it'll help solidify it. So I always tell people it's going to be about half an hour of me talking, and then we've got a half an hour left for you asking questions at that particular point on that meeting. I'll also give you my direct phone number. Feel free to use it. Please don't abuse it, is what I always tell people.
Right.
702-371-2345. But the best way to get in touch with me is to just book an appointment. And then that I will have blocked out the time, and I won't be crazed getting a bunch of other phone calls or not being able to talk.
In fact, don't call him. Book an appointment. Okay, be prepared to book an appointment because you'll have your questions. Because right now I think we've just got you excited. I mean, I might be the first one on the schedule next week. I think there's some good stuff there. Most of y'all are growing. You know, our goal of our show is to build cash flow and build financial independence. So. But you also got to protect it and make sure it passes on to your family intact in perpetuity. And that's what we mean by building a legacy. And so this is how the wealthy do it. And so, folks, it's hard to win a game you don't know the rules. And so Bruce just gave y'all some of the rules, okay, that people don't know, that the Kennedys know, that you don't know, okay? And so that was a very powerful information that we just got today. Bruce, any closing thoughts or words of wisdom for my listeners out there?
I think the best word of wisdom is this: you need to be proactive rather than sitting around and being reactive. Here's a great opportunity for you to do exactly that. I know that I myself have been involved in a couple lawsuits, and believe me, they cost me dearly, hundreds of thousands of dollars. It can get very, very ugly. And now that we've got this just wonderful vehicle that's there, let's take advantage of it. Let's at least find out about it and see how it makes sense and fits in with our life, our lifestyle, and our business to carry us forward and give us the protection that we all know we're in the most litigious society in the world. There's Absolutely. No place that has more litigation going on. So let's protect you. Let's have a conversation.
Let's do that. So listen, folks. With that, I want to thank you guys for listening to another episode of the Practical Wealth Show. So we're going to have all of those links in the show notes. Make sure you reach out, tell them I sent you, so that people know they're getting listenership from being on the Practical Wealth Show. Just kidding. And so again, thank you so much for being of this week. Do me a favor, go to leave us, if you like the show, leave us a comment, leave us a rating on iTunes, and that helps more people find it and get this message out of how to be in control, to protect and grow your personal economy, which is our mission. So, Bruce, thank you again for taking your time out and being on the Practical Wealth Show today.
Thank you so much for allowing me to be a guest. It was a sincere pleasure.
Yes, thank you.
Thanks for listening to Practical Wealth. To access the show notes and resources, go to practicalwealthshow.com. To get your questions on the show, go to practicalwealthshow.com. This show is for entertainment purposes only. Before you make any investment decisions, consult a professional. This show is copyrighted by Practical Wealth. Written permission must be granted before syndication or rebroadcasting.